Good morning and welcome to 5 Before the Bell, TheStreet.com's daily market preview and global market update right here in the central London studios of Core TV and the heart of the financial district in what I think is the most important financial city in the world, London. And I'm the London Bureau Chief here at TheStreet.com, so I suppose I would say that. My name is Martin Bagdax. Welcome to 5 Before the Bell. We're going to take you through those 5 things you need to know before the start of trading today on a payroll Friday. That, of course, is looming large all around the world, but we are seeing a decent and bullish sentiment. We'll get right to it with European markets because we're looking good across the board. About 0.5% to the upside for the broadest measure of European shares, and that's the Stoxx 600 index. We're seeing decent, although not spectacular, gains in bourses around the region. FTSE 100 a little bit less so, considering the fact that oil prices are on the decline and the oil majors are a heavy weight to the UK benchmark. But nonetheless, it's a good solid day, and the European numbers were corroborated by a very strong reading for manufacturing activity in the Eurozone. In fact, the PMI index from IHS Markit hit 57.4. That matches the June tally, which was the highest in 6 years. And actually, surprisingly, we saw the highest number in 6 years out of Italy as well. So that does suggest that the recovery, which is ongoing here in the European economy, is broad-based and isn't simply itemized inside the core of the Eurozone. So that's really important indeed, and a big part of the reason that we're seeing the gains that we are. Now, it has to be said that investor sentiment was a little bit clipped by what we've seen this week with respect to the rising US dollar and whether or not, I do beg your pardon, what I meant to say was the rising euro and whether or not that was going to hold back equity gains. I beg your pardon, but we had a very important ECB race setter today, the governor of the Central Bank of Austria, Ewald Novotny, who said that effectively we aren't looking at interest rate rises from ECB anytime soon, given the fact that inflation remains tepid in the Eurozone. So I think that poured some cold water on anticipation of a near-term hike from the ECB. And of course, if you have easy monetary policy and a very, very strong economy, which we have here in the Eurozone, that is the recipe for stronger equity gains. So that is the reason why we're seeing this decent performance prior to the payroll report, because typically European investors wouldn't want to reach that far until they knew exactly what was happening in the United States. So it is nice to see this market trading a little bit independently of what's happening in the United States. I'm going to move on and talk about Vivendi. They were one of the big star performers on the market today. At one stage, shares were up just under 8%, and that was the biggest jump in about 10 months. Now, Vivendi is a French media conglomerate. They're best known in Europe for the Canal Plus offering. It's one of the big pay TV providers in France and indeed all around Europe. It's something that I watch on vacation all the time. They have a fantastic set of programs, most of which nobody's going to understand unless you speak French, but I'm lucky enough to have grown up in Canada, so it's okay. However, what is very interesting inside the Vivendi story today is Universal Music Group, which is another division and, of course, is one of the biggest music labels in the world. Despacito is one of the songs inside the UMG stable. And, of course, as we know, it's unavoidable, and it's been listened to close to 5 billion times, and that is billion, since its launch earlier this year. It's the most listened to and most downloaded song of all time, and it has driven profits at UMG. In fact, UMG profits in the second quarter were up just shy of 54%, and they represented the lion's share of a better-than-expected Q2 reading from Vivendi, whose numbers were published late last night in Paris. So the market had the first kick at it today. They lifted the shares quite significantly. It really is a fascinating story and indicative of the ways in which the media landscape is changing so quickly, because you have a song from artists that most people had never heard about only a few months ago, raising 5 billion viewers and listeners in interest in about a 7-month span. It's been at the top of the Billboard 100 for a record-tying 16 weeks, and it does represent, again, the changes that we're seeing in the media landscape. Now, Vivendi has some other problems. It's trying to incorporate Havas, which is one of the world's biggest advertisers, into the broader group stable, and there's some criticism as to whether Vivendi has overpaid for that, particularly when you consider that Havas only a couple of weeks ago said it wasn't going to meet its 2017 targets, and WPP, an advertising group here in London, which is the biggest in the world, had a very disappointing set of quarterly earnings only a couple of weeks ago and warned about its potential to grow in the United States and elsewhere into the second half of the year and 2018. So that is going to weigh on investors who are looking at Vivendi as a standalone, but the company is talking potentially about spinning off Universal Music Group through an IPO. They don't have any strategic plans just yet, but it is a consideration. And if they can get lucky on a couple of more hits as the way that they have with Despacito and others, it's probably going to be a compelling story. Now, moving on to the United States, one of the big business stories today is an open letter that was written by several U.S. CEOs, 350 in fact, that was led by Facebook's Mark Zuckerberg. Now, the reason behind the letter is a program called, well, it's basically known as Dreamers. Effectively what it does, it's an Obama administration holdover that gives rolling work permits to about 800,000 illegal immigrants who entered the United States as children many, many years ago, have stayed on and have basically found their way into the employment space and are now really an integral part of the U.S. economy. There has been reports, and President Donald Trump has promised to scrap this program during his election campaign, and there have been reports that he may do so as early as today. So last night, CEOs led by Zuckerberg, Apple's Tim Cook, Jeff Bezos from Amazon, Warren Buffett from Berkshire Hathaway, just a who's who of American corporate bosses, wrote this open letter to Congress and to the president saying, you have to reconsider this, guys. It's an incredibly important program for the growth of the American economy. They say that it could result in about $500 billion worth of damage to the U.S. economy if indeed it were canceled and the immigrants that have been targeted by it were to be deported, as the president has alluded they would be. So it's an interesting story simply on face, given the fact that the CEOs are talking about the economic impact. But what I think it also represents is a troubling issue for the president in the fact that he is losing corporate America by the week. You'll remember that his slow-footed and really inadequate response to the violence that surrounded the white supremacist rally in Charlottesville, Virginia, last month led to the scrappage of 2 advisory panels after Kenneth Frazier and others, Kevin Plank, and other CEOs decided that they couldn't work with the president given the fact that he was simply not able to condemn white supremacists in the way that he needed to. So the fact that the president does seem to be losing the support of corporate America at exactly the time that he's trying to drive corporate tax cuts, for me, is an interesting development indeed, and indeed is nonetheless so, given the fact that this program has such an integral part with respect to jobs growth in the U.S. economy and indeed overall economic growth. So we'll watch this one with interest, and we'll find out hopefully today whether the president has reconsidered his view to scrap the Dreamers program. Staying with jobs, of course, it is Payroll Friday, and we can't get away without talking about that. 8:30 a.m., the Labor Department will give us the figures for the month of August. Analysts are looking for the economy to have added about 180,000 jobs over the month. That would be just shy of the 184,000 average that we've seen for 2017, and probably, however, a little bit lower, but I say a little bit lower, notably lower than the 206,000 that we saw in the month of July. The headline unemployment rate is expected to stay unchanged at 4.3%. The number I'm going to be most interested in, however, of course, are the wage figures. We're looking at an advance on a month-on-month basis for weekly wages of about 0.3%, according to analyst estimates. Now, this will be the most interesting number, I think, because despite the fact that the labor market is relatively robust, even though the pace of job creation this year is the slowest in 5 years, we're still looking at unemployment at only 4.3% and a labor market that is close to full capacity. However, we're just not making as much money as we have in the past, and that is a big problem for policymakers, particularly the U.S. Federal Reserve, but those outside the United States as well. If the wage growth isn't what we anticipate it will be, that could change the dimension of Federal Reserve rate path, certainly this year and into 2018. This is the last labor market report prior to the Fed meeting on the 19th of September, and at the moment we have investors betting on a 36% chance of a rate hike in December. So I do wonder if these wage figures are going to change that dimension, and certainly the fact that the dollar has sold off in the last day or so could indicate that it will. We've also seen U.S. Treasury bond yields for the 10-year space falling down to about 2.12%, and that's the lowest it's been in and around, well, not exactly the lowest, but within touching distance of the lows that we printed back during the election. So it is a cautious step that investors are taking going into this labor market report. And if it does miss on the downside, and if the wage numbers are disappointing, you could imagine that the dollar is going to lose some of its ground. That'll probably be very positive for European and global stocks, but may not necessarily give Wall Street the jump that it's looking for, even as I look right now, though Wall Street is looking a little bit better, and the Dow Jones has called about 53 points to the upside. Now let's move on to Wall Street, actually, in fact, because we are looking at a decent start to the session. Nonetheless, though, we got to keep an eye on the dollar, and I do want to update you on oil and gas prices because that has been an interesting development overnight. The United States tapped the Strategic Petroleum Reserve for the first time in about 5 years last night. Only 1 million barrels came out, but nonetheless, that was an added supply dimension that drifted oil prices lower. So we're about 1% lower on the day for WTI crude prices. However, gas prices continue to rise. We're looking at gas futures at about $2.14 a gallon, and that takes the national average at the pump up to close to $2.50. We haven't quite gotten there yet, but we will likely over the weekend. However, there is good news with respect to gas prices because if you look at gas futures for October delivery, the prices that are quoted at $2.14 are for immediate, for September delivery. The October numbers are about $1.77 a gallon. So it does suggest that prices are going to come back rather quickly once production comes back online. It does appear that the floodwaters have peaked in and around Houston as a result of Hurricane Harvey, and that is excellent news from a human perspective, but it's also good news from the economic perspective because it will mean that refiners will be able to come back online more quickly, perhaps, than anticipated. There is going to be a near-term supply disruption. There's no doubt about that, but the market is pricing in a quick turnaround, and therefore will likely to get back to normal gas prices come October or November, and that is going to be good news for consumer spending. Another stock to look at the start of trading today is Lululemon. It's called about 6% to the upside. Blowout Q2 earnings last night. Very solid sales at the top line, but also the online dimension of the athletic apparel company rising very, very strongly indeed, about 30% better than anticipated. And that's good news for the whole of the sector because there have been some major concerns with respect to the underperformance of people like Under Armour and Nike. But Lululemon seems to be bucking that trend, and investors are rewarding them with a decent gain in pre-market. So we'll watch that one with interest. They also posted Q2 earnings of 36 cents a share, a little bit better than Wall Street estimates. So we'll watch that, watch oil, and watch the dollar. And of course, everything is probably going to change as a result of what we get from the payrolls at 8:30. So watch that with interest too. And come back to thestreet.com. We'll have live updates and rolling coverage of the important data points and everything else is happening in the markets today and all day long. That's it from me from Central London. I'm Martin Backerdax, London Bureau Chief at thestreet.com. Thanks for watching, guys. Good luck out there, and we'll see you Monday.